who's coming to us from Washington via Zoom today. He's very familiar to all realtors. He's the chief economist for the National Association of Realtors. He's also the senior vice president of research, including existing home statistics, existing home sales, affordability index, and home buyers and sellers profiles. He regularly provides commentary on real estate market trends for our 1.4 million realtor members. He also creates forecasts and participates in many economic panels, among them the Wall Street Journal and Harvard. Please welcome the esteemed Dr. Lawrence Yun.
Hello, everyone. I think the technology is working. I will assume it is working until someone tells me otherwise. But very good afternoon. I know the room that you are in because I was there in person a couple of times in the past. Unfortunately, this year, as I am requested to do so many Zoom interviews, it's very difficult to do travel. And maybe next year, I can be in your area, just lovely area next year. Well, in Washington, there's many things going on. I think the most important thing is that the Federal Reserve is set to do another big interest rate increase in a few weeks. And then another one after the midterm elections, and then probably another one in early 2023 before stopping and possibly some reduction in interest rate late in 2023. That depends on the path of the inflation. If the inflation can come down, we can make the adjustment quickly. But if the inflation lingers, and when I say inflation, I am looking at consumer price inflation, home prices, interestingly, something that Brad mentioned, wow, 40% increase in home prices in Florida past 2 years. Well, that is not counted as consumer price inflation. It's not part of that equation, but just the overall consumer price inflation. You go to grocery store, you are frustrated. You go to gas station, you are angry. So trying to bring that consumer price inflation to manageable levels. And if so, the Federal Reserve does not need to be so aggressive. But so far, all the information is 75 basis point increase in a couple of weeks, and then another probably 50 basis point increase in after midterm elections, and another one in early 23. So that is the expectation on what Washington will be doing related to Federal Reserve. Let me give you how I see the market developing. With that, I speak better with PowerPoint slides. So let me put that onto the screen. With Brad, Elliot, myself, economists, economists look at many similar items. So there could be slight repetition in some points, but the reinforcement of these ideas, I think this is good. And to the degree that there is any disagreement among us, I think that's always very healthy to see why we would disagree on certain aspects. So let's first start with the broader economy. We are in an economic recession. At least I think so, because when I took Econ 101 course, we always said 2 consecutive quarters of a decline is an economic recession. So you see, in the first quarter of this year, second quarter of this year, it is negative. Now, it is mildly negative. It's not any big negative. It's just mildly negative. So that would essentially say we are in an economic recession. But some people are saying, no, this is not. We have to wait until the committee decides. And there's a group of economists who will determine probably 18 months from now. But who cares what they say 18 months from now? We want to know what's happening today. And it's 2 consecutive quarters of decline. But note how mild current changes are compared to the early data points. The early data point shows a huge whiplash reaction from COVID and reopening of the economy. So when the economy shut down, everything collapsed, no economic activity. And then when the economy reopened, for which Florida was one of the very early states to reopen, the economy began to come around, and then some positive before turning negative in the recent 2 quarters. If it is a recession, it will be the most bizarre recession of all time. Because, let me go advance, because we are in a labor shortage. The blue line reflects total job openings in the economy, help wanted signs. At hotels, help wanted. At restaurants, help wanted. I know many hotels. I know you are local residents, or you are going back home tonight. But for visitors to Naples, they're staying at a hotel, and they will say, no, we cannot clean your room every night. It will be every 3 days. Those would be the criteria, because they just don't have enough staff to handle it. You see it at the restaurant. Help wanted sign is far higher than people searching for a job, reflected in the orange line. So by almost 2-to-1 ratio, we have more jobs than unemployed. This does not mean that there are some friction in the marketplace. If you are a mortgage lender and recently lost your job because refinance business has completely dried up, and the mortgage lending industry, they are laying off workers, well, you are not going to take that job from 7-Eleven or at the hotel. So trying to get that right job match is going to take some time. So just because there's plenty of job openings does not mean immediate filling of those jobs. But nonetheless, it is a bizarre recession, because recession means more unemployed, very few job openings, but that's not the case right now. In terms of at least some type of job, it is plentiful. If we look at 50 states map, it looks like the following, and someone in the back may not be able to see it, so I will read the numbers to you. Florida, easy to identify. It says 4.8%. So what does the 4.8% imply? In the state of Florida, there's 4.8% more people with job today compared to March 2020, when that ugly COVID came to the country. So before COVID, Florida was doing well. Well, today you have 4.8% more jobs compared to March 2020. So this is a high performance activity in the state of Florida. Georgia plus 3.8, Texas plus 4.8 is color coded. So the bluish color states, they have more jobs today compared to pre-COVID. While the red color states, they're actually down. For example, New York, Brad shows the data, how many New Yorkers are coming to Florida. Well, in New York, there is 2.4% fewer jobs today compared to pre-COVID. So variation across the country. And one of the key factors for this variation, I would say, is the degree of reopening of the economy. So the states that reopen the economy sooner have more jobs, while the state that was sluggish, like Pennsylvania, Michigan, New York, they're all down. Now, other red states, so I should say, I don't want to go into politics. I'm just using this job number part. So other red color state that is red is oil producing states. So Louisiana is down, North Dakota is down, and Alaska is down, because many oil companies are saying, look, Washington, things that politicians are saying from Washington is saying they want to kill oil companies. And if that is the case, why should we invest so much in new pipeline, new drilling? So the caution among oil drilling companies are leading to job reduction in some of the oil producing states. Texas is so well diversified, oil is not as important as before. But that's the reason also why you are angry at the gas station, because we're not producing enough oil. Now, certainly Naples is beautiful. I would not like to see any oil rigs right outside of Naples beach area. You don't want to see that. But in some areas like Alaska, North Dakota, where there's hardly no one living, well, if we could drill oil, why not? But to the degree that we're not drilling oil, is making the oil prices a little higher than what it could be. Now, green energy is definitely important. We need to transition over to green energy, but still it makes a very tiny fraction bulk. 90% or better energy is coming from carbon fuel, and we cannot quickly dismiss the carbon fuel overnight. So that's the job performance with Florida doing better. If we look at specifically at your area, Naples-Immokalee-Marco Island, so this is what the job number looks like over the past 22 years, from year 2000, turn of the century. There were less than 100,000 people with job in the Naples region in the year 2000. Then there was an increase, and then you faced foreclosure crisis, so you lost a job right in the middle of the graph. And then again, rising before COVID disruption. Now you have more job compared to pre-COVID condition. And the total job numbers are about 60,000 or 65,000 more jobs now compared to year 2000. So these are quite remarkable growth given the relative size of your local market, which is the reason why home prices have took off, because you have so many people moving into the region, many retirees. Retirees don't want a job. But retirees go to restaurants, retirees need nurses, retirees need financial advisors. So all that support staff job creation is needed along with the home building construction job. So Naples job creation has been quite remarkable. But housing market, at least from the beginning of the year, is showing some declines. So this is the pending home sales contract. We know not all pending leads to closing. There are some canceled contracts, very frustrating. I mean, you feel like tearing your hair out when the contract is canceled, but it occurs. But still, it is a very good leading indicator about actual commission income and the closing activity. So what you see on the chart is the red line shows right before COVID, what it was. Then we had the disruption from the lockdown. Once the lockdown was lifted, reopening, home sales surged way beyond pre-COVID days. So there was 2 years of remarkable performance before beginning of this year, steadily declining. Why is it declining? We all know. Your clients are completely surprised about the impact of higher mortgage rates. I wish every governors across the country would put some degree of financial literacy into their high school curriculum to say, you have to learn this. And what is this? Mortgage calculator. Punch in the number and see how fast monthly payment changed from small changes in mortgage rates. So the mortgage rate was 3% last year, and now it's essentially knocking on the door for 6%, which is the reason why sales are going down. You know, some people who don't have mortgage calculator, okay, 3%, 4%, 5%, what's the big deal? Well, you punch in the number and it is a very big deal. Now, fortunately, in your area, there is a larger than normal amount of cash buyers because New Yorkers, Chicago, San Francisco, they sell their home, expensive home, and come into the market all cash. So, you know, cash buyers are very immune. But still, mortgage borrowers are still a significant size of the market, and the sales are coming down because of higher mortgage rates. So this is directly off the website from the Naples Board of Realtors. So they have all the good data, and you probably are aware of this data. Brad covered all the other data points. But overall showing that inventory has risen, 88% increase. Percentage-wise, it looks like a big increase, but it is still below 2019. I mean, you just did not have any inventory last year, and now you are beginning to have some number. But the pending contracts, you are falling more than the rest of the country. Rest of the country is down about 20%, but you are down 34%. One thing that I am noticing is that expensive markets are seeing larger decline in pending. So San Francisco, New York, New Jersey, and some of the expensive areas seeing larger decline in pending because mortgage calculator, that impact is much more impactful or negatively impactful on higher priced homes. So that is the condition currently in your marketplace. If we look at the price appreciation, there's all different price measurement. You know, Brad went over the median price. What I'm looking at here is loans that is backed by Freddie and Fannie, which means it doesn't cover all homes. But of the homes that are covered by Freddie and Fannie, what they do is they don't look at the median price. They do something called repeat price index. So the same property They see what it was when the first loan was originated, say in 1990. Then the home buyer or home sellers change. So in 1998, say after 8 years, another mortgage was taken out and they see the valuation. So for the same property, what is happening to the price? And they average that across all properties in Naples for which they have the data, and is showing that prices are up better than 30%. So very similar to median price, but I thought that it would be interesting to show also repeat price measurement. Now, one thing to note is that current increases looks like similar to what happened in 2005, 2006, earlier part of the graph. And then what happened? There was a foreclosure crisis and prices plunged. Could it happen? Well, people who don't know the background, who just look at the graph may say, it's a possibility. But we have to look beyond the graph. And the beyond the graph is we don't have overabundance of inventory, oversupply situation. That's not the case. And another big difference is that, thank goodness, we don't have subprime, funny, risky mortgages. People who took out a mortgage are of sound credit. In fact, I would say to you to recontact your clients over the past 2 years, shake their hand one more time and say, congratulations, weren't you lucky to lock in that 3% mortgage rates? It's about building relationships so that maybe they know a friend who's going to move from Chicago and say, look, I work with this realtors. I have a home, 3% mortgage rate. And because of that feeling of building wealth, locking in low rates, they feel good. And that feeling good will essentially transmit over to you. And of course, you did a fantastic job in getting the home for them. So remind your past clients what right decision they made, and just a good reminder that they have made that terrific decision. I mentioned the Federal Reserve will be raising interest rates. So the red line is what the Fed controls. It's the interest rate, not for you and me, but for the banking system. But the blue line is what we are interested in. That's the 30-year fixed rate mortgage. And today's data is showing that it is the highest since 2008. So it's highest in more than a decade. So it's rising. But one thing to note is the following. Look at the middle of the graph. In the middle of the graph, you see that red line goes down, goes up, goes down, yet the blue line barely changed. So it is possible that when the Federal Reserve changes their policy, that the mortgage rate could remain very stable. Of course, it's not the current case. In fact, currently, mortgage rates are responding violently to any hint of further changes. But my best guess is that the reason why mortgage rates shot up quickly is they knew that the Federal Reserve would be raising interest rates multiple times. People know inflation is high, meaning that Federal Reserve will be super aggressive. So the mortgage market is trying to price in all this future action. So in September, in a couple of weeks, when the Federal Reserve raised interest rates, mortgage rate may not change all that much because it already priced in. Same thing after the midterm election, same thing in early. So I think the most of the increase in mortgage rates have already occurred, and it will be very small movement from this point onwards. I think the home base for mortgage rate would be about 5.5% to 6%, maybe 6.2%, and just bounce around that level. I don't foresee 7% mortgage rate, even though the Federal Reserve is saying they will raise interest rate. The mortgage market already priced in that conditions. Here's what realtors across the country are doing. Every local market is unique, so Naples is certainly very, very unique and special. But across all MLSs, we've been tabulating the number. What we find is that half of the homes are being sold at list price or above, but the other half needs a price concession to sign the contract. And this shows the relationship with the days on the market. So what other realtors across the countries are doing. So on the first week, to the degree that there is some price negotiation, price reduction is 5%. In 1 month, price reduction is 7%. But if home sits on the market for longer than 3 months, price reduction is 11%. So the actual data, how much price reduction from the list before signing the contract, which means that you need to price the home correctly. If you get that home sellers, congratulations. Next meeting will require what is the price, list price. If you misprice the list price, well, it's going to stay on the market for a long period, price reduction, price concession, and before you know it, it could be 11% lower before finding a new buyer. So understand the market condition. You are the experts in looking at your neighborhood specifically, but this would be the overall condition. The data that is always worth emphasizing and re-emphasizing, especially to the first-time buyers. I think the first-time buyers know they want to buy a home. The reason why they're not buying is they are priced out. Higher mortgage rate, they simply cannot make the numbers work. Based on their income, it doesn't work. But to the degree that there are some renters who have the financial capacity but refuse to buy, you have to show this chart. It shows that homeowners build wealth over time. According to Brad, 40% price increase in 2 years, that is a huge gain in wealth. Just consider, the home owner just a couple of years ago versus now. But this is showing, according to the Federal Reserve, what the wealth gap between homeowners and renters. To be very specific, the blue bar, the middle bar, is the actual data from the Federal Reserve. But that's 2019. Federal Reserve has not updated the figure. They will, I'm not sure when it's coming out, but I know prices have increased tremendously since then. So my estimate, based on reasonable assumption, is that homeowners probably have around $320,000 in wealth. Given Naples region, Marco Island is much more expensive. I mean, you are looking at $500,000 or even higher net worth for homeowners in your area. But just huge, vast difference between wealth between homeowners and renters. So any renters who have the financial capacity but refuse to buy, I would say they are not making a right decision, because we know the home prices will be rising, and 6% mortgage rates. Well, let me think. My parents, they bought their first home when the mortgage rate was 15%, and that was one of their best financial decision ever, because home prices steadily increased, and when the mortgage rate went down, they could refinance downward, because we know the mortgage rate goes up, but it also goes down, and when it goes down, one can always refinance downwards. And when I bought my first home, mortgage rates were 8%. It was the best decision. And I will give credit to my wife, because she insisted we have to buy. I was a little hesitant, but once we bought it, it turns out that it was the best decision ever financially. Showing tremendous wealth difference between homeowners and renters. Inventory levels are very low. Another thing to show to your potential buyers who think, oh, home prices will crash. No, we don't have inventory. Yes, inventory levels are rising, but even with the recent increases, it is still way below the normal condition, and definitely not the case of 2006, 2007 conditions, where you had an oversupply. Back then, 4 million homes available. Today, we have only about 1 million homes available on the market. I remember the front page of the Miami Herald, where it said there is something like 40 years supply of inventory back during the foreclosure crisis. 40 years supply. I mean, those are scary numbers. But people who bought right at that time, I think they are smiling big at the moment, because prices were falling condition. But today, with such a tight inventory, don't expect prices to decline. And maybe some markets like California, where it's super, super expensive, maybe they see some price adjustment, but it's no big deal in terms of causing market distress or foreclosure crisis, because it went up so much, it's super expensive. So any reduction in, say, 5-10% price reduction in San Francisco, I don't think it will cause any great concern to the financial industry or to the homeowners in that area, other than just few buyers who bought right at the peak But I think the prices will, after the drop, will go back up again. It's not going to be a sustained decline. It will only be a temporary decline. In the Naples region, I doubt that you will even see a decline. But if it does decline somewhat, it will be very modest and temporary. And those people who buy at those temporary dip in prices, they will come out well ahead into the future. The building activity, something that Elliot may go into, I'm not sure, because again, we did not speak to each other, which is good for you, which means we are making, nothing consensus. So to the degree that we have disagreement, it's all good that you are getting fresh perspective. So inventory build, the supply is rising, as you can see. But the increase in supply of the builders, which is the reason why they're becoming very cautious, not wanting to build more, is homes that is either under construction or they have a housing permit for. So they have a housing permit, and now they're trying to sell that empty lot, and they are saying, okay, we want to build, but who's going to buy this? And right now they are not finding so many buyers or saying cancel contracts. Because unlike existing home, once people buy those new homes under construction, you don't know when it will finish. In 6 months, 9 months, will the garage door arrive on time? So all that question, and in the meantime, mortgage rates are changing, and that's why you have cancel contracts. But look at the red line. On the homes that the builders actually completed, ready to go on the market, inventory levels are very low. So what the consumers are saying is they're hesitant to buy under construction, but they want to buy a home once it's all ready and done. So very low inventory regarding the finished homes on the market. And consequently, I would say the builders, I know sometimes you have to take a risk. I would say go ahead and build more because there's a housing shortage. I know right now mortgage rates are higher, there's cancel contracts, but once you finish, you are selling it and you are selling at a profit. So I would encourage builders to build. The single family construction is on the right-hand side. And what you see on the right-hand side is first, no overproduction like back in 2006 or 2005. So you see much more subdued. It's been rising, but in a subdued way. But in 2022, the green bar, I think is going to be a little down for the builders. But apartment buildings are just cranking up. And to the degree that, we want a home ownership society, well, this graph is quite discouraging. We are producing more apartments, but not enough single family starts. The scale of the chart is a little different, but I'm just showing the direction. Directionally, the multifamily starts are, I think, the highest in 30 or 40 years, while the single family, as you can see, is retreating this year. Consumer confidence. How the consumers view about the economy. I think the consumers are saying we are in a recession. Again, the debate, are we in a recession or not? What the consumers are saying, they don't feel good about the economy. Consumer sentiment index, according to University of Michigan, is very, very low, multiple year low. And people get a daily reminder at the gas station and at the grocery store. Every single day, they're reminded things are not right. Here's another depressing survey. Survey by Fannie Mae. Simple question. Is it a good time to buy? And it is very low. But let's keep in mind, what people say and what people do not necessarily match up. Look at 2020. Do we see a boom in the people's response to say it's a good time to buy? No, we didn't see a boom, yet we know that home sales increase. Because if the timing is right or the mortgage rate is low, right property appears, people will take advantage. So right now, people are saying it's not a good time to buy. But if there's a right inventory, maybe they will step into the market. Or if there's a little dip in mortgage rate in some weeks, take advantage of those dips. But let me give you a little slightly different survey. This survey is from the New York Federal Reserve. And the question is a little different about home buying. So the question is not about, is it a good time to buy, but rather, is buying a home a good financial investment? Furthermore, they do something much more, I think, that is more complete, not partial, much more complete, which is they're asking a question about rents. What do you think is going to happen to rent? The second line. And people are saying, well, I think the rents will rise 6.6% a year. Florida markets is rising much faster. So once you pose a question about rents, people say, I don't want to pay higher rent, then another higher rent a year after. So once you embed into the people's mind about rent, not just about home buying, but you have to look at all the choices, and the choices are rents. And so once you put the question about rents and then ask the question, is that a good financial investment to buy a home? 73.6% say yes. Very few, 6% say no. So once the rent question is put in there, people are saying buying a home is a terrific financial investment. So my final slide to wrap it up, the forecast, what you can anticipate is the following on a nationwide basis. So these are the national figures. 2019, pre-COVID, nothing exciting. Home sales, no increase. Home prices rising 5%. 2020, first year of COVID. First half of the year, a lot of disruption, but second half, boom. So the total year was very positive. 2021, 12 months of positive activity led to 8.5% increase in unit sales, 16% increase in prices on a nationwide. You experienced higher price increases. But the forecast for 2022 is that first quarter was decent, second quarter not so, third quarter looks ugly, and fourth quarter looks ugly in terms of unit sales, down 20 or 30%. But nationwide, I think it's going to be down only about 13%, especially the Midwest, where things are very affordable. Like markets in Ohio, it's so cheap that changes in mortgage rate really do not impact their monthly payment. So I think the Midwest would be very insulated. So considering all this, I think the unit sale will only be down 13%, maybe more in the Naples-Marco Island because you are more expensive market, but the prices will still be rising. And of course, your area actually may see bigger price increase once all the December numbers are in. So the dollar volume may be cut about 2%. Then by 2023, let's hope this recession is clearly out of the way. So job creation. I mean, we are actually creating jobs during current recession, but once we are out of the recession, we will continue to add more jobs. And Florida has been the leader in job creation, and therefore that would be the source to provide support for housing. For nationwide, I put 0% increase in unit sales. That's nationwide, but Florida will easily outperform the nation. So you are in a better position. So thank you for listening. Thank you for allowing me some time to share my ideas with you. And again, thank you very much.